Run it. I can't take no loss. I don't even know what it costs. I hit the ground, then it go off. Yeah, hit the ground, then it go off. Yeah, I can't take no.
Hi, and welcome back to the Conscious Day Trader. I am Yanis, and today we're going to break another pound-dollar trade from Friday, and it was the 3rd of Feb, NFP day. So quite a tricky day when you're trading it. Let's have a quick look on the results. And as you can see, I've listened to your request and I've taken away the graphics just so you can see better in the background. So let me know if this is what you're looking for, as in you can see better everything on the screen. So what we're going to see here is 431.50 from Friday, and it was quite a good trade. I had to reposition. This will be a good video for the people that keep asking on stop losses and how I deal with management of the trade. So we're going to go in detail of that. Straight away, let's jump onto our trade sync. If you want a discount on this, drop me a message. I think I've got 40% of it. It's for lazy people. If you don't want to do journals and you just want to throw the data into this software, it just gives you all the results. So this was the big month that we had in January, and this is the start of February. I couldn't trade Wednesday because I was being given the new account. So what we're going to do is jump on TradingView, and as you know, I traded the pound dollar, and I was looking at the correlations with the dollar index. So what we're going to do is start on with the dollar index, and let's take everything off again, because I think this is good practice for remove drawings. For everyone to who's trying to follow through, to start doing this themselves and yourselves, and then the more you do it, the more familiar you get with ICT concept. Let's start on the daily, and the information we had was from the 3rd. So this is the outcome of the day, but on the day you wouldn't have this candle. It was down here somewhere. So you would take the horizontal ray, go on the previous day on the 2nd, and put the daily high in and the daily low. When you've done that, then you're going to grab the Fibonacci tool and grab a horizontal line to get your 50%, which is your equilibrium. And just to demonstrate what that means is above here we've got premium price, and below here we've got discount. So if the price was on the upper side of here, you are trading in a premium environment. So if you wanted to go long, you would have to wait and get a better price, either bring the price back to equilibrium or down to even better on previous daily lows. And you keeping an eye on the left side and seeing where we are at. Remember that the first thing that pops out is this sell side liquidity below this candle here. And that sell side liquidity has got taken out, created the previous low around the 100.8 value. So that's one thing. We've got the sell side liquidity. And then also on the left side, we had this fair value gap here. This is the daily fair value gap, which also got filled halfway, 50%. And then the price went to the upper side. So this is what in terms of sell side liquidity and fair value gaps on the daily. Then what we'll do is jump on the 15-minute, and we'll see how we're going to trade this. This is now 7 o'clock yesterday in the morning. We're using the replay so I can show you what I did. And the first thing that you can see here, and you can spot like you would spot this one, which we traded to the upper side, on the sell side on the pound, we've got an actual value gap here. So you would take your box and allocate that fair value gap, that actual gap there, gap in price. On the lower time frames, these gaps will tend to come and fill. And let's see, how far is that? How many pips? 60 pips on the index. Now, if the index is weak and is pushing into this fair value gap, what do you think the pound is doing? The pound would be strong. and we're going to go into that. But this was the time, 7 o'clock. I wanted to find a setup to long the pound. If my daily bias on the daily for the pound would give me a setup to go long, that doesn't mean that every time we see a gap or we see a setup on the index, we want to be the opposite direction of the pound. It helps because that aligns with the correlation of the two charts, but you always have to analyze your main trading chart and get confluence with the index. So and if you do have a pro version, you can open these two charts at the same time, and you can see a lot of the times when this fills to the pip, you'll see then the reaction into the pound dollar. So that was the big interest that gave me start looking into the pound dollar. What we also looked at was this fail of the previous high, and now it's coming down. Next target in terms of buy side liquidity, you do have these equal highs here, roughly equal highs, and you had these spikes into this area. So to combine the whole thing, you can identify that as buy side liquidity. Yes, you do have this wicks, but you can see we've got a swing high, a lower swing here, high, swing high here, and swing high here. So you combine those to make sure it gives you a group between pricing. And if you can see the round number there, 102, if we get that, it would be above these swing high here. So that would be an area where if the price was going higher, and we'll see what happens on the dollar index, it would go and take out. So now we've got that information from the dollar index. Let's go on to the pound. So remember what we are looking for. Let's take the replay and we go to 7 o'clock. What we are looking for is longs. So now, since we've done all the daily highs and daily lows on the index, I won't do the same for the pound to save some time, but you can do that. Go on the previous day candle. And as you can see, we're looking at the previous daily low, and we've been trading below the previous daily low. Let's jump onto the daily and get a picture of what the pound has been doing. Okay. Now, why would I want to be long in this setup? If we look at this fib here, from that start of the move there to that there, we can see it came back down, closed below the 23%, and then came back up and it got rejected. Rejected this, it created an equal high, didn't break the highs, and now it's trading lower. So on the next candle, with the combination with the dollar, it probably would have been a better bet to be short on the dollar. However, my bias was long, and this is a key, some key information. Remember that we also had an FP event which affected this. So in the morning, the session, the trade for the long was good, but as the NFP hit, we had a sell-off. So if I was in that trade, I would have been wrong. So what we're going to do now, we're going to jump onto this chart here. Out of interest, now that it's happened, if we throw a fib on that, we'll see that it just went to the 61%. So full recovery of that move. And now it's trading potentially for the next targets, which will be sell side liquidity below this area here. Okay, is that going to happen next week? We'll find out. The other option is that it comes back up and it takes the buy side liquidity above these highs here. The market can do three things. It can go down, up, and consolidate. And that's where you need to identify every day when you come in. What is going to be this day? Is it going to be consolidation? Is it going to be a sell-off, or buy side liquidity sweep, or sell side liquidity sweep? And it's that simple. You need to make it simple and identify where you're going to be targeting your next highs for profits. What's going to be an easy target to target your highs? What's going to be a hard target, such as going down in this move here, 300 pips when you already had a sell-off? That would have been a hard target for that move. What we're also going to see, you can see a fair value here on the left side. Let's put it in now, since we've seen it. Good practice. You've got a fair value gap there, and this is on the daily. And these are covered. So pretty much that was the setup that we were looking at. And we're going to go on the 15-minute. And we're going to start now breaking down the trade. How did I enter long here? As you can see, we had this break of structure above this buy side liquidity here. I wanted to trade this back into equilibrium would have been quite ambitious, but to trade it up to the previous daily low. So that would have been a very generous 50 pips. And the setup was quite good. We had a push down below the previous daily lows, and we consolidated in the Asian session. And I was quite confident that this, with the gap on the dollar index, that I could long this before we go into the NFB time, which would be 1:30 UK time, and to be out of the trade, so I don't get on, because if you don't know the direction during NFB, you're pretty much gambling. So you want to be out of things that you can't explain. Now, what also we're going to see is on the left side here, if this allows me, we had this fair value gap. This is on the 15-minute, this fair value gap here. We came up, filled up, and then let's put it in. So from that candle to that candle, a small fair value gap. And let's see, out of interest, where this fair value gap will be with the current price. Okay. So that gap got filled. Do we have, this is process that you will be doing before you get into the trade. Is there anything on the left side of the chart that can be of value? This fair value gap's got filled. In terms of targeting, we've got this sort of swing lows here. That would be the next area. And you do that, I like doing it before the market opens. So when the market opens, I don't have to go back and forth to identify areas where the market could potentially go to. And that is another fair value gap on the 15-minute. Okay, so then what we had the criteria of ICT. So we had a break of the highs, and then we were waiting for a fair value gap to fill. And my original fill was a really bad fill. It was on the top here. It wouldn't be with ICT rules, but with the actual trade, I was in a bad position here. So I got in at this level here, which is 122.06. Let's just double check that. This $17 here for close. If we go to actual trading view, I've labeled this so you can see where I got in. And as you can see, as soon as I got in, the price came down. And this is where I start doing my, I'm trading on the 1 minute. This was the 15-minute. This is where I'm trading, doing the Yanis. How scary did that look on the 15-minute? The good news is that I'm trading on the 1 minute, so I can manage that. So what happened is I entered here on a fair value gap fill from that break of the move on the previous highs. The price came down, and I got a second fill on another fair value gap. Now I've got my two positions, and how do I manage these? Now this might look scary, but it's only 3 pips, 4 pips. Like I've said with stops, my risk reward is how many times, how many days will it take me to recover a loss? Because I'm running on a very high win rate. So I'm averaging about $400 to $500 a day. So if I lost $2,000 in a trade, that would take me 4 days to recover that. And the question is, am I happy for this trade to risk 4 days of work? And in this case, it didn't go that far down, but I was in a drawdown in the whole trade. It went down to minus $800. So someone will see that, and if they don't understand what I'm doing, they will think that I'm risking $800 to make $400. That's not what I'm doing. I wouldn't kill it if it went $800 and won. I would kill the trade if I was down about 2,000, because it doesn't happen often, and that would be roughly half a week's work. But then I have to trade and get back into it. What happens is that happens again. So I have 2 weeks off. Then I will start questioning and saying, am I risking too much? But for this moment of time, which in my data, in my journaling that I'm doing on this one on the calendar, and as you can see from the previous month, we're running on all green days. So with this, there's no reason for me to, because my analysis is good, there's no reason for me to change things until something happens. And as a data analyst, you want to see the change happen and then be ready for it. But you do want to have your security there, which for me now is 4 working days. So when you ask me where the stop loss is, I will always tell you that my stop loss is out all the way. I don't care. I have a stop loss for a maximum stop loss per trade would be sort of the 500 total, which would be so 2,000 in total. And depending on how I manage my trades in and out, that decreases because I'm getting better price, and the price is coming down. So instead of dealing with a regular stop, which would be 40 pips, now my risk of the trade, even if it broke these lows, would have been at 13. Now you might have said, what would have happened if this candle didn't do this and it went all the way down to losing 2k? That's fine. I would have killed that trade. What's the chance of that happening? Not very likely, because the London session, like we've discussed in the previous days and weeks, it's especially the London kill zone between 7 and 10. It will do like 30 pips, 50 pips, 120 pips when it's crazy. And that would mean a single directional move, like a black swan event, without any opportunity for me to get a better price. And now that I've explained that, and hopefully for a while, for the people that follow me, get it. If you don't, drop me a message and I'll try and explain it again. So what we've got here, we've gone down, and I had my second entry. When the price came and recovered this position, and it went even in profit, but I wasn't there to kill it, I killed this position because I didn't like where I was sitting in relevance to, not breaking the previous highs. So I was anticipating this coming against me, especially when the dollar index, if we jump quickly on the dollar index, had filled that gap here. So it was going to go, there was higher chance that the price would go higher to buy side liquidity. So that was an area where I was quite wary of the trade. I didn't want to put bigger size. Normally I would put 2 to 3 positions if I'm really confident about the setup. So I saw that fail, breaking these lows, coming down, breaking these lows. And I had these 2 positions, and I desperately wanted to get out of this position here. So when it came up and it failed to break the highs, came back down, I just killed it for $17. Came back down, all the way down. And then what I did is I got a fill from this fair value gap. So this break here of those intermediate highs, remember my bias is always long. So I'm trying to trade to get a better price going long. You might see this move and say, this is a shorting opportunity, but for me, it's a repricing opportunity. And I'm getting out of a bad entry and getting in under a better entry. So I've killed this one, so I've only got exposure of this one now. This comes down, fills this fair value gap, and I enter. And at the time I had saw that this didn't break these lows here, so I entered my second position. And these are the positions that I took in. Now, because I've got my 2 positions in and out, this is the area where I was quite happy to be in. I didn't like this trade. So what I wanted to do is I wanted to get a better price in this fair value gap and this fair value gap. But now I didn't want to have these lot positions. If you're thinking that looks like a huge move, I'm down 24 pips. So this was about $400 loss for me, but I was confident that this would be going up. So yes, this method is not for everyone. And if you are learning ICT and you've jumped onto my videos, this potentially, killing the trades when it breaks the lows for 3-4 pips, it's more than acceptable. And you would probably wait until to get another confirmation to go in. But we need to be clear with this in terms that this is good for me, is not a method that everyone can use. So now I killed this trade soon as it got tapped. So now I've got an exposure of 1 trade. So 1 trade came down, and this is pretty much as harsh as I've seen it come down into the London session, 36 pips in one directional move. So I averaged in, so we had 1 trade there, 2 trades there, and 3rd trade there. So my maximum exposure was 3 lots. And then it hovered, came back, and I took that trade out. And I had 1 trade. So this 6th position now is my main trade. I do have to fight against this position that I have here. But even if you look at this, if you tag a Fibonacci level on this, if the price comes back to here, I'm break even, I'm back to 0. So I'm risking, even though I'm not taking tight stops, I'm really managing the trade as it's happening live. And this came and took out the liquidity below the lows. It never went really against me, because if you think that this is 8 pips and the 25, so 30 pips, someone might think that's a lot, but for my sort of trading, it's really regular and there was not a lot of stress. And there we have it. And the trade came back up. So someone would say if you had kept this, there would have been a lot more profits. But I don't care about the extra profits that I would get. I just want to get out of the trade. And then we had the break, and we had some clean ICT trading all the way to the top. And I believe I was out at this stage, but if I had kept that, it did go all the way 65 pips in this range here. So really good profits. And this came back down, and from memory tapped the fair value gap and broke the highs. And a beautiful delivery. And this is 11 o'clock, and you can see we came above the previous daily lows. However, it didn't go to the daily lows, but this trade, if I had held it, would have still paid me 80 pips. But I was happy because it's NFP day, super volatile day. And what happened to the price? Consolidated until the news came in, and pound dollar came down on news, for good news for the dollar. And then it just traded lower and lower and lower. So this is an example on a day that was a down day. If your analysis in the London kill zone is long and could justify your long position and you can manage it accordingly. So let's get worst case scenario, because this might sound scary to some people to deal with this. If the price continued down out of this, so I've got 3 lots positions and it went down here. That position would have been 40 pips. This position here would have been 20 pips. And that position would have been another 20 pips. So that's a lot of pips. But like I said, I'm risking $2,000 every time I go into the trade, because my history and my performance indicators are showing me that I can pound average and decrease the risk as this is going against me. But worst case scenario, this came all the way down, didn't consolidate here, and tapped me out for 2K. that would be my hard stop. I would kill the trade there and look for something else to do, either for the day. I wouldn't trade the NFP, so that would have been a lost day for the week. Because we had $900, a $2,000 loss would have given me a $1,000 loss. But if we look at the history, I'm averaging around 2.8, 2,000, so it would have been a week's worth loss. It's a bit different concept, and the Scruffy trader made that clear to me. It's like when I was back in the day when I was trading the Scruffy method. And if you don't know who Scruffy is, I would definitely recommend going and checking his YouTube out. He does explain the markets really clearly and has a simple method, strategy, if you want, an approach to the market that is will make you understand why tight stops, if you are consistent and you've proven to be consistent, can take you out of trades without risking too much, really, when you have a high hit rate, when you're looking at 80 to 90% win rates, and you are able to bring back home £400 to £500. It doesn't make sense to be killing the trade too early before you have done your analysis, because you've got the 80% of the wins to take out the 20% of the time that stop is going to be hit. I hope that's made sense, and let's go back to this video. And the stops is quite an interesting discussion, and there's always going to be a conflict of interest. I do this with my stops, you do this with the stop. The key thing about stops, if it protects you and it protects your account, that is the right stop for you. Don't look at my way of trading and say that is the right way. No, that way is the right way for me. And that's a key thing about if you're doing tight stops and you are successful by trading with a 40% win rate, but your risk ratio is so high that your profits are outweighing your losses so much, then don't change that. Keep doing that. However, if you're a really super consistent trader, then you can deliver 10, 20 pips in a day. A tight stop might be stopping that progress of your profits. And there's two schools of thought. ICT, tight stops. Scruffy trader, wide stops. Yanis management of the trade, like I showed you. And Scruffy does also Scruffy Madness, which he pounds averages down into the trade. So there's so many ways you can do it, but you have to identify what works for you and your psychology and your trading. You don't want to be nervous when you're doing it. And I'm not nervous at all when I'm trading or stressed. And that's a key part of your trading where you will know, okay, this is the right path, because I can deal with this sort of drawdown without being stressed. And I've got a logical position where I'm going to be coming out. I hope this has made it clear. I hope you like the video. Make sure you subscribe. This is a Saturday video from yesterday's trading on the NFP. A bit of a bonus because I was too busy yesterday. And we'll do it all again next week on Monday. I hope you have a good weekend and see you then.
I can't take no loss. I don't even know what it